Welcome to the Deep Dive, where we deliver that knowledge shortcut you need by, well, stripping away the noise and jumping straight into the insights.
And we've got a lot to get through today.
We really do. If you've been watching the markets, you know we're in this moment of just pure tension. Indexes just had their worst day since October 10th.
A really broad tech sell-off. There's real anxiety there.
But at the same time, you have business leaders, especially in AI, sounding more optimistic than ever. It feels like we're caught between the floor dropping out and, shooting for the stratosphere.
That tension is exactly what our sources capture. Our mission here is to give you a really high-definition snapshot of an economy that's transforming fast.
We're talking technology, consumer behavior, regulation.
Right. It's all happening at once. We need to find where these forces all intersect. So where do we start?
Let's start with the engine behind all this optimism and volatility, the AI economy, the conversation among HR leaders. It's not about if AI will change jobs anymore.
No, that ship has sailed. It's about how quickly. And the numbers are, frankly, stunning. You've got 89% of senior HR leaders expecting AI to impact their firms in 2026.
It's basically tomorrow. So what does that impact actually look like?
Well, what's fascinating is it's not just about mass layoffs. The source material says it's about reshaping the future of work by redistributing tasks within jobs. They're redesigning the human's role.
And that must have a practical outcome, right? I mean, for hiring.
A huge one. The expectation is a major shift toward, and I'm quoting here, skill-based AI-enabled hiring rather than the traditional degree-based hiring.
Okay, that's a massive takeaway if you're thinking about a career change. Skills over degrees.
It is. But here's the contradiction. 61% of those same leaders say AI has already increased their company's efficiency.
Which is a great productivity number.
A huge gain. But the main reason they're cutting headcount right now, it's a general need to cut costs. They are not blaming AI efficiency for the layoffs.
So there's a gap there. Are they just using AI as cover for cuts they already needed to make? Or is the efficiency gain not quite there yet in terms of, net labor savings?
For now, it seems like the big economic pressures, inflation, interest rates, are just a bigger deal than the tech argument for automation.
But the productivity boost is real.
Oh, it's very real and measurable. There was a study from the London School of Economics that found employees using AI save, on average, 7.5 hours per week.
That's an entire workday just given back to you.
It is. Which is great for the employee, but for an investor, it brings up this huge dilemma.
Depreciation.
Exactly. We're talking over $1 trillion being spent on data centers in the next 5 years. The accounting question is, how long does that very expensive equipment actually last?
And this isn't just any equipment, it's the NVIDIA GPUs, the backbone of this whole revolution.
Right. And companies like Google, Oracle, Microsoft, they're projecting a useful life of maybe up to 6 years for this gear.
But is that realistic?
Well, you have skeptics, like short seller Michael Burry, who are arguing it's much, much closer to 2 or 3 years. The pace of change is just too fast.
And you even had the NVIDIA CEO, Jensen Huang, basically confirm that. He joked that once their new Blackwell chip shipped...
You couldn't give Hoppers away.
And to unpack that, Hopper is their current top-of-the-line multi-thousand-dollar chip.
And Blackwell is what's next. So he's essentially admitting that a multi-million-dollar asset can become almost worthless almost overnight just because of innovation.
And that uncertainty is what's driving the volatility we're seeing. The AI-linked pullbacks have been brutal.
Look at SoftBank. They made this dramatic move to sell their entire $5.8 billion NVIDIA stake.
To fund their bet on OpenAI.
Right, and SoftBank's own stock plunged for days afterward. It shows how interconnected these bets are.
And it's not just stocks. That volatility spills over.
Absolutely. Bitcoin saw a 4-day decline, dipped below $95,000, a 6-month low.
Why, though? What's the connection?
It's the same class of investor. The high-flying AI tech trade in crypto. They often have the same highly leveraged institutional players. When one trade gets shaky, they pull back from the other one too.
Okay, so we have market anxiety from tech speed and depreciation. Let's pivot from Wall Street to Main Street. The consumer is definitely stressed, but maybe not in the way we'd expect.
That's a great way to put it. We used to think consumer distress was just, the lower income households pulling back.
But now we're seeing something different. This trading down phenomenon is hitting high-income shoppers.
And that fundamentally changes the retail models.
Yeah, look at the data. McDonald's is seeing more high-income customers because of their extra value meals. You've got chains like Applebee's and IHOP pulling people away from more expensive restaurants.
And this isn't just a feeling. The sources confirm it. The thrift store chain Savers Value Village noted measurable growth in younger and more affluent customer groups.
They called it a definitive trade down.
They did. And look at Walmart. They continue to just crush it by attracting households making over $100,000 a year who are looking for value. They're really outperforming Target and Dollar General.
But while the affluent are trading down, specific younger demographics are getting hit the hardest. Gen Z and millennials are really feeling the squeeze.
Absolutely. That
What?
cohort, roughly 25 to 35 years old, they're dealing with slowing job market, rising unemployment, and of course, student loan payments are back.
And you see that directly in their spending habits.
For sure. In the fast casual dining space, chains like Chipotle, Cava, Sweetgreen, they all had to cut their forecasts. Why? Because that younger group is just visiting less. They're cooking at home.
And at the same time, their ability to buy a home is being crushed by tightening credit for the builders?
Yes. Credit for residential land acquisition and construction, they call them AD&C loans, it's been tightening now for 15 straight quarters.
15 quarters, that's incredible.
And it's not just about higher rates. Lenders are changing the actual terms. 60% of builders said the most common method was lowering the loan-to-value ratio.
So for you, the listener, what that means in simple terms is that builders have to put up way more of their own cash up front.
Right. And that just kills any project that's on the margin. It immediately restricts new housing supply.
So even if rates have come down a tiny bit, the effective rate on a land acquisition loan is still over 10%. Housing stays tight, rent goes up, and it all comes back to hit that younger consumer.
Now, let's pivot to the other end of the spectrum. Let's look at how the ultra-wealthy are deploying capital and some of the regulatory battles that are reshaping finance.
Okay, so for the billionaire investor class, the idea of a trophy asset is changing. It's not just about art or classic cars anymore.
No. Sports teams are now a mainstream investment for family offices. It's really incredible. 20% of family office principals now own a controlling stake in a sports team.
And that's up from...
Just 6% in 2022. It's a massive jump. Sports teams have officially overtaken art and cars for this group.
Is it just for fun, or is the money good?
The returns are strong, mostly from media rights. But there's also the non-financial side, the active involvement, bringing the family together. It's a powerful mix.
Speaking of high-stakes capital, let's look at New York City real estate. There were a lot of fears around the election of Mayor-elect Mamdani and his democratic socialist policies.
Right. But the top local real estate CEOs are saying there's no corporate exodus, they're still bullish, they're closing deals on high-quality office leases in as little as 21 days.
So the local money isn't scared, but what about outside investors?
That's where you see the split. Overseas institutional investors are getting nervous, they're worried about potential rent freezes, and that is causing a chill in capital flows from abroad.
So politics is now a material risk factor in pricing New York City assets, even with strong local demand.
Exactly. Now, shifting to retirement. This isn't just a problem for millennials. We have some really sobering data on baby boomers.
The numbers are pretty stark. Only 40% of young boomers, so 61 to 65, are actually on track financially.
And the median shortfall they're facing is about $9,000 a year. So the question is, how do you close that gap?
Well, the researchers have one so-called silver bullet solution.
It's surprisingly simple.
Mm.
Just work 2 years longer. Retiring at 67 instead of 65 boosts preparedness up to 47%.
That's a pretty big jump for a small time shift.
It is. The trickier topic, though, is home equity. The average boomer has about $113,000 in home equity.
And if they tapped that, it would boost their preparedness all the way to 60%.
Theoretically, yes. But most people see their home as an asset of last resort. There's a huge emotional attachment. It's not just money, it's memories.
That emotional barrier is a powerful economic force that I think gets ignored in a lot of these policy discussions.
I agree. Now, on the regulatory front, we just saw a really decisive power shift. It favors big banks over fintech.
This is about JPMorgan Chase securing deals to get paid by firms like Plaid and Yodlee.
Exactly, for accessing customer data. And critics are calling it anti-competitive rent-seeking behavior.
Which is a fancy way of saying what?
Imagine you built a highway, it's open, it's working, and then a third party comes in and just installs a toll booth.
And starts charging everyone to use the road that was already there.
That's basically it. Big banks are now charging fintech companies a fee to access the very customer data that those fintechs built their businesses on.
Meanwhile, on global trade, we're seeing a bit of a mixed bag.
A very mixed bag. On the one hand, a big win. The U.S. and Switzerland finalized a deal to reduce tariffs on Swiss imports.
And in return, Switzerland pledged a massive $200 billion in U.S. investment by 2028.
A huge positive. But contrast that with the cost of tariffs on U.S. beef prices.
This is a big deal for consumers at the grocery store.
It is. Tariffs on beef from places like Brazil, plus tariffs on imported feed and equipment. It's all compounding the pressure on the U.S. beef supply chain.
And this is happening when the U.S. cattle herd is already at a 75-year low.
So it's a perfect storm, pushing prices higher for consumers.
And finally, we have to mention the government shutdown. It's over after a record 43 days.
It's over, but it's created a data vacuum. We expect the September payrolls report soon, but the sources are saying the October CPI inflation report, it may never be compiled.
Why not?
Because you can't retroactively collect the in-person data. So we're literally flying blind on a key inflation metric, which just adds another layer of risk for the Fed.
So let's tie this all together. What does this all mean? We've got technology saving employees 7.5 hours a week.
Which is an incredible metric.
Yet the markets are completely fixated on GPU depreciation, worrying about the true cost of that leap.
And at the same time, you have consumer stress driving even high-income shoppers to trade down, while policymakers are trying to balance good trade deals with tariff-driven price hikes. It's messy.
So the financial world is just completely divided.
Deeply divided. You have investors like Ron Barron who see these tech sell-offs as a huge buying opportunity. And then you have Fed officials warning that inflation is still way too sticky for any more rate cuts. It's a fundamental disagreement on which way we're headed.
So I want to leave you with one final thought to mull over.
Okay. If AI is projected to save every employee almost a full day of work per week, and HR is already shifting to skills-based hiring, but right now they're only cutting jobs because of general economic pressure.
What's the inflection point?
Exactly. What is the true societal inflection point when AI efficiency officially becomes the #1 reason for massive workforce reduction?
Yeah.
And what does that do to an already stressed consumer economy where even the wealthy are hunting for value?
That's the central risk to watch for over the next 12 months.
And now you have the context.